G'day everyone, welcome back to another episode of the Australian Property Investment Podcast. I'm your host, Aaron Christie David, and I run a mortgage broking business called Helia Wealth, where we specialise in helping property investors start out and scale up their property portfolios. And what underpins that for us is helping property investors and also homeowners make confident property decisions. With confidence comes knowing your numbers, also building that knowledge around you and the team that's going to come on that journey with you. I mean, see, that team needs to walk in your shoes 3-4 steps ahead of you, has done this multiple times as well. And that's the aim behind each and every episode, is to bring someone in that's what we call best in the breed, so they know their industry, they know their products very, very well as well. And today I'm extremely happy to bring in Strachan Taylor from Helia Insurance. Welcome to the show.
Thank you very much, Aaron.
Now, the reason why I'm super excited is mortgage insurance, is lender's mortgage insurance, or LMI, is a conversation that we have. It doesn't matter if you're an investor or a first-time buyer or an upgrader, something that comes up consistently. And people are trying to understand, how does this work? How is it calculated, for example? And we're going to kind of pull the curtain back a little bit and look under the hood of LMI. But before we do kick off, I want to have a little bio about yourself. So you've been in finance for quite some time.
Yep.
Having studied at the same uni, for example, UNSW, being a dad to 2 daughters. I think we could almost have a podcast completely about that, because I think you said your daughters are a bit older than mine. So I need to know if I could lose any more hair, I might. But just kind of avoiding some teenage issues coming up.
Yeah.
And
they keep you on your toes.
I'm sure they do. I like to start and call what I call the 3 Ps about yourself personally, professionally, in your own property journey as well, Sean.
Sure. Okay. Well, personally, as you said, 2 teenage daughters that are keeping me very busy.
Yeah.
A beautiful wife, live in Gladesville. Been in Sydney most of my life. I have worked overseas, which was good, and good to get that experience to the different markets, both in London and briefly in Hong Kong. My passion at the moment, apart from raising the kids, is try and get away to a bit of skiing.
Nice.
Finally, Japan opened up this year, so we snuck over and had a lot of fun there.
How wonderful is that?
And
I feel like that's a sport you could do as a family for quite some time.
Oh, it is,
isn't it?
No,
it's like it's good ageless type sport, isn't it?
Very much so.
Yeah.
The kids will be very soon out skiing me. So
how good's that?
It'll be lots of fun. And also, as I said, trying to teach my daughters the finer points of rugby union.
How's that going?
It's funny. They get very amused at me shouting at the TV. My team is not doing well. But anyway.
Yeah. As soon as your daughters are a bit older, 1 are 2 and 4. So as soon as the KO comes on the TV, they're just running at, Mum, I've lost this. And I learned it.
Yeah. About my professional career, so I've been largely in banking and finance for most of my life. I did a stint in fast-moving consumer goods, which again was interesting about how to deal with customers and how to engage with consumers, which taught me a lot. Spent quite a while at Westpac, sort of learning the banking sort of profession, and then went out on my own and ran a mortgage broking business.
Fantastic.
Like yourselves. Wasn't for me, but I learned a hell of a lot.
Yeah.
And again, you really learn about the market you're in when you're sitting in front of prospective borrowers.
Correct.
And trying to explain to them how you can help them get into the market.
Yeah.
Which was very good. And I've been at Helia, which was originally Genworth. I think everyone remembers Genworth.
Yes.
We had to rename ourselves because our major shareholder, Genworth Inc. in the US, sold us down a couple of years ago.
Yep.
And therefore we lost the right to that name. Still the same company.
Yeah.
Although I would say the same company but on steroids, because we're now looking at a whole range of different ways that we can help people get into the market, not just LMI. And so watch this space, because there's some stuff coming.
Beautiful. I love it. Yeah, Helia to Genworth, I'm very curious about the name change. It's different name, same proposition.
Pretty much the same proposition. We've done a lot of work about how we can improve that proposition.
Yeah.
Technically, we're a B2B provider.
Yeah.
We insure lenders. But the guys that you get benefit most out of it and also pay for it is the borrower.
Correct.
And we're really sort of upping the game in terms of the way that we engage that space.
So let's start there, because you're going through a bank, but it impacts the borrower, for example, and you've been broking, you've been in banking. So the first question a client goes, mortgage insurance, I hate it.
Yeah.
And why am I paying it? And you get met with plenty of objections, for example. I guess you sit in 2 camps. It's either friend or foe. It's either that friend that helps you get into the market and it's a necessary evil, or it's foe. And I think Scott Pate, Barefoot Investors, has been a big advocate of not paying mortgage insurance. I personally, and I'm not saying this purely as a broker, I'm saying this when I went to buy my own place, for example, I couldn't physically save a 20% deposit. And if I ever got close, property prices moved, and now my 20% deposit was more like 10%. I was like, well, hang on. I feel like I'm chasing my tail. Surely LMI is the springboard to get into the property.
Yep.
Yeah.
Yeah. Look, that's great analogy, and you're right. Trying to save a 20% deposit, especially now, is tough. It's like chasing a shadow and trying to nail it down. It keeps moving. Even with the way the property prices have come back, it's still a lot of money in the Sydney market alone. A bit of history, let's wind back. Genworth started in 1965 because back then you could not get in the property market unless you had 20% deposit.
Yeah.
Right. And the reason for that is quite sound. It's about risk and risk of default, and you want a strong financial system. And we're very lucky in this country we do. And we haven't gone through a lot of the problems that a lot of places in the rest of the world. So in 65, the government set up an insurance scheme that said to lenders, we will provide insurance, right, to allow you to actually lend up to 95%. And it was targeted at first home buyers, which meant that instead of 20%, you had 5% plus costs, much easier to get to.
Absolutely.
And so that's how we started. Over time, because the way that insurance is priced is based on risk, the amount of the loan, right, and how much you borrow in terms of LVR.
Yes.
Now, back in 1965, your properties were about £2,000, right? In Sydney, not a huge amount of money.
Yeah.
They were still quite a high percentage, right, of your income.
Yeah.
But a lot less than they are today. Over time, that's gone up. So the cost of insurance has gone up, and that conversation that you do have with borrowers, they're looking at an additional 10, 15, 20,000 plus.
Yes.
And when someone's been saving for a long time, to be told that there's another cost,
spot on.
It's debilitating. And I get the way that. My view is those that are not informed will say it's a rip-off or it's expensive, you don't need it. Our view is, look, we provide a mechanism of getting into the market sooner, and it's a pathway, right? It may not be for everyone. In fact, the way that the government has set up the home loan deposit scheme was actually to try and help those that would never get there, even with LMI, right? And we're working with the government to make sure that they're focusing on the right cohort, but also not going too deep. Because if they offered that to everyone, then there's no skin in the game, and it becomes quite an interesting structure in terms of what is the role of government going forward. But anyway, I digress. So LMI, it's a pathway into the property market, and you're right, it means you only need 5% plus costs.
Yes.
Right?
Yeah.
We've seen numbers that can take someone anywhere between 5 to 15 years to save that 20%.
That's exactly right.
And then you think about, so where a property price is going to be in 5 years or 15 years.
Yeah.
Now, if you then are looking at 5% plus costs, then that truncates that to 2 to 8 years, maybe 2 to 5 years, and then you can actually get into the property market, and then away you go.
Correct. And then we were talking before about the record of compounds, so the annual average,
in property prices, and this is put out by CoreLogic. I had a look at that yesterday. In Sydney, over the last 30 years, it's about just under 6%. I think it's about 5.5, 5.6% compound annual growth. Average price for a house now is $1 million-ish in Sydney. So that's $60,000 today, and then another 6% on that at 1.06, and then it keeps going, right? If you were looking to buy a property in Sydney today and you had 5% deposit and it was $1 million, you're going to be paying around $40,000 in LMI, right? And if initially you go, wow, that is a lot of money, okay, that you're going to have to stump up. And I agree, it is. But you got to think of what is it going to do, right? It gets you into that market now, and using that average growth rate, your property's worth $60,000 more. It only costs you $40 to get in.
Yes.
20 ahead.
The other part of that equation is if you've been renting, you've got a sunk cost for that rent. So if you're renting $1 million property, for example, you pay, $30,000, $40,000 in rent, for example, even if you're sharing a house. So not only is that $30,000 or the sunk in rent, but the $40,000 you think about it like, well, I'm going to pay rent anyway. Is LMI the lesser of two evils potentially? And I'm in the home that I want, in what I can add some value to this property as well. So it's not exactly dead money. I won't criticise rent as being dead money either. but it's a way to be in the market and you control the asset now as well, right? Yeah. So you add some value, do some work. So you're talking about increasing $60,000 purely just on average compound growth. What happens if you gave it a lick of paint, maybe some new flooring, for example, did something cosmetic to it and increase the value even more?
Absolutely.
As well.
Absolutely. Yeah. So look, we're all about trying to help people get into property.
Yeah, I love it.
Okay? And we're doing a lot of work in that space.
Yeah, great. Bank to bank. So from a broker perspective, when we do the mortgage insurance premiums, we do it by lender. It varies. So how does that risk appetite work between different banks?
Yeah. So look, again, it's all assessing risk and you price that risk, and different lenders have different policies and take on different risk and perform differently. So that's why you'll see quite slight nuances in the actual cost of that LMI depending on the lender.
Yeah.
It's based on their past performance and basically the claims we've had to pay to those lenders. There's not a huge variance. There used to be. The variance between lenders now is actually, probably come back quite a bit.
Yeah.
But you will see those differences, right? And that's just based on risk and performance.
Okay. So when we talk about risk, there's certain, I guess, bands that I'll discuss, say, with our clients, for example. So a 5% deposit. So then we're moving to a 97%, including mortgage insurance, total loan to value ratio. Or we're at 90% plus LMI, or we're 90% including LMI, which generally from our numbers is one of the sweet spots for mortgage insurance. So 12% deposit plus your 2% puts you at 90%.
Yep.
Some lenders will then below the rate if it's over a 90% loan to value ratio. And you've got this last little band, which is that 15% deposit somewhere to nearly that 20%. So you're kind of scraping in there as well. And so you've got these little tiers of LMI. So is that something that happens in the back end from?
Yeah, and look, you're spot on. It's something that I think the savvy brokers understand. And look, there's a lot of mathematics and probability behind all of this. Yeah, some very, very smart people that we have that look at risk over time and how to price that. And so what you see is as you borrow more versus the value of the property, then historically there's different risk profiles attached to each of those. And so you will see jumps in both the LMI but also the interest rate because you're pricing for risk, and historically you've seen more losses as that goes up. Yeah, so that's why you see that. So it definitely is worth having a look at that and how that plays out. Yeah. And can you actually assist your borrowers saving some money if they don't? Can they go to just 89, right, as opposed to 90? Or if they're at 90, can they stay at 90 and not go to 92? Yeah. So they're all things, and that's the value the brokers bring, right? So they can provide those scenarios to the borrower. We have actually created a scenario tool that's open to both borrowers and brokers called the Deposit Comparison Estimator.
Okay.
And what that is, it's essentially a scenario tool that you can sit down with your borrower or your customer and talk them through what options they've got. Yeah. And it allows you to say, well, what deposit have you got at the moment? How much you're looking to borrow? What's the gap? Can you get in now? If you can't, then what are your options? And that could be, do you qualify for a government scheme? All right, how does that work out? If you use LMI, what's that going to cost you? And you can also look at how much property price is going to go up over time. And that allows you to have a rich conversation about, well, is it the right time now? Or should I wait and keep saving? Yeah. Right? And that we find that's a very rich conversation, and it provides all the pathways that is open to someone to get into property.
Nice one. Yeah, something we had a chat earlier is as a parent, you kind of see the world slightly differently, right? And I think you have this responsibility. I think parenthood, that's when you start to think about really, really putting down roots. Kind of finding a place so you're not renting. We're in our home, our family home, and it has a very different feel to it. But then also, I guess, the way we're educating and getting the kids to see the world through potentially our eyes, we have a huge impact to play on them. And one of those I feel it's very, very strong is that home ownership and the push for home ownership. I've probably had people that have sat out of the market going, when's the right time to buy? Everyone says it's a cliche, buy yesterday or buy today, and you won't regret it. I guess having fast forward a little bit more and with your life experience, you've seen people that have been in the market, people are now priced out of the market, maybe stuck in that rental trap that can't afford to get back in. And now their kids are probably going, we haven't seen home ownership, and now home ownership feels like it's something that's out of our reach potentially as well. To your point earlier about the compounding growth, how expensive is property today versus when our kids go to buy, we also have a huge role to play around making home ownership attainable, not only for our customers, but doing it for our family as well.
Yeah, very true. And look, whenever I'm asked when's the right time to buy property, I say it's always the right time to buy property. Okay, because you're buying, you're not trading shares. You're buying an asset that you're going to keep for quite a while, right? And you should keep quite a while. One of the regrets I had is that when I had a unit in Darlinghurst that I sold and then bought something else, I should have kept it. Right,
that's one of the most common regrets. Either not buying more when I have the chance, or selling. Probably one of the two biggest regrets that investors tell us.
And you learn, right? So
hindsight's a beautiful thing, right?
Expensive lesson, but I learned that. And look, I agree with you. It's parents should be helping their kids where they can, right? Yeah. But they've also got to work out how they can actually help, and especially if you've got multiple kids. A lot of parents got quite large deposits for their kids.
Bank at mum and dad, I think, is one of the largest. I think fifth or sixth bank in the country.
Yeah, it's massive, and I get that. It can create a bit of stress. CPO internally.
That's family and money.
Yep. We do a lot of research with first home buyers, and our latest research found that there's quite a lot of emotion attached to going to your parents and asking for money and assistance. And this is where LMI can help in that space.
That's exactly. The amount of times I say, look, is family an option, say a guarantor loan or cash, and I either get, we'll open to it, or it's firmly just shut down. That's not a topic. I'm like, okay, well, now we're talking LMI.
And other options. And that's what we want. We want the conversation to be about options.
Yeah.
Right? But also have LMI there as part of that. I think anyone that shuts that down is actually doing themselves and their kids or their borrowers a disservice in terms of what's going. As we say, it's not for everyone, but it is a viable option. The other thing with kids, and you'll see it, I look at my kids and all the different apps and things that they use, and I am so out of touch, right, with what they go. And what's happened in property, as you see, is that the whole market dynamic is very different to what it was when parents were probably buying their first home, right? And so to come at your kids with ideas that are 20 or 30 years essentially out of date is dangerous. And so
20, 30 years ago, the real estate agent was driving my parents to the home in their car and looking at property, and they get 30 minutes on a Saturday to look at it, if that even.
That's it. The dynamics changed and things have changed. The attitudes to property and finance have changed, and also the options available to you are very different. So education of kids, and I'd prefer parents to be far more open-minded in terms of the options available, and also get their kids talking to brokers early.
Yeah, correct. Devil's advocate. I mean, mortgage insurance has, I won't say static, it's evolved over time, but the property market has kind of proved itself to be quite resilient. Mm-hmm. So it's often the conversations we get pushed back. We get from some clients come on, the property market's fairly resilient. We know this property's going to go in growing value. Mm-hmm. Why is the LMI premium so high if it's like adjusted for risk when we know if we're buying in a really good area? We know it's going to increase in value. Its price, we're not overpaying for this home, and we're good borrowers, so the risk of default's low.
Look, and that we hear that a lot. Again, as I said, we've got some very, very smart actuaries that price this stuff. It's based on historical performance and views going forward. You look at the GFC, right? Yeah. That was quite a shock to our market. We came through relatively unscathed. Right. We, as an economy, as a nation. But for us, we paid out a lot of claims through that, and banks had a lot of foreclosures that they had to deal with. Right. Same with the mining boom. Right. So that created, and again, that was more. The GFC was nationwide. Mining boom was in pockets. Yeah. But there were some big losses in that space, which we all learnt from. And again, we paid a lot of claims to make sure that the banks remained financially viable, so that they're still around today to actually lend money. And that's why those premiums are set where they are. Yeah, okay. Because you're pricing through the cycle. Now we're going through a downturn at the moment. We hopefully it's coming to the bottom of that. And you've got to understand that there are going to be people under stress, and there are going to be people, unfortunately, that may not be able to make it through this, and will have to either exit the property. Okay, and that might mean the property is not what the price of what they bought it at.
Yeah, fair enough. No, I appreciate that, and I guess hearing straight from the horse's mouth, that's the source of truth. That's what we love about kind of having experts on like this as well. The other one that I've got for you is refunds. Now, refunds on LMI, I feel like it's that TikTok video where you pay $1 a day and it keeps the interest offset, for example, which was full of it. But and I feel like there's some pundits that go around saying we can get LMI refund, and there are examples possibly where you are, but
you can.
It's not open to everyone. So can you take me through the mechanics? Yep,
sure.
Who is eligible? How does it work?
So refunds are available. It depends on the lender you're with.
Yeah.
The lenders do offer the refund. If you refinance, pay it out or whatever in the first 12 months, you're entitled to a 40% refund of the value that you've paid. And if it's in the 12 to 24 months, it's 20%. And that's pretty much an industry standard that we have. Now, people say, well, that's not a lot, given it's only been for 12 or 24 months. Again, comes back to risk. Most claims happen in the first 3 years.
Okay.
If there's going to be a claim, it usually happens in the first 3 years.
Yeah.
Hence, that's why most of your premium is taken in those early years, which is why those refunds are at 40 and 20%. And they do exist. Those that don't offer the refunds generally put that back into the price, and so the price is a little different.
Okay. So have you got an example that we can maybe work through? So take me through this. So someone's bought a property, say we'll go back to $1 million. They bought it, say 92%, so it's $920K loan, for example. The property goes up in value in the next 8 months. What's the process in and around getting that reviewed or looked at?
So if they keep that loan, then they don't get it reviewed because that loan is still insured, and we insure loans for their entire life.
Okay.
Right.
Yeah.
And that is a bit different to the first home loan deposit scheme that only insure the top 15%.
Okay.
Which lenders are sort of working through how that actually works for them. And so if someone's paid a premium for a particular loan, then that loan is covered for the life of that loan.
Yeah. Okay.
Right. Now, if they want to then change that loan, right, either refinance internally, top up, or pay it out completely. If they pay it out completely, right, then if it's within that 2 years, then there's generally they're entitled to some form of refund.
Okay.
If they want to borrow more for whatever reason, or buy another property and use the equity as part of the deposit, then we actually look at that and we do what's called a top up on that. And if they've already paid a premium and the loan changes, we actually credit that premium as part of the next premium that's the spouse offered, right? So you're not paying as much.
Correct.
Yeah.
Which I think is one of the most secret tools for investors, right? So investor initially got in and paid like a 90% LVR, paid the mortgage insurance. We can then draw back up to say 90%, not and like saying work the numbers and how much extra.
Yeah, it's a lot less. You will have to pay some because the risk has changed. It all comes back to risk, which I know is quite technical when you're talking to a lot of borrowers. Yeah. But the risk has changed. There will be a little bit more insurance to pay, but you're not paying the full freight.
Yeah, love it. Love it. Perfect. And then the other part of the question is when a client applies for a loan to be mortgaged, so say we go through a bank, I'll pick out one, we'll go through NAB, for example, or CBA, and then they've got to then send it up to the mortgage insurer for sign off, for example. Now, some banks have the ability to sign off internally.
They do.
And then some banks have to go, say, to Helia and say, look, we need you to sign off on this loan. And the client's going, I don't understand this. We've gone to the bank and now they've got to go to someone else, for example, and then come back to us. It has all this is like knock-on effect in their application.
And how does that hard to understand? Look, we have been working quite hard over the last few years to essentially provide lenders with what we call delegated underwriting authorities, which means they make the decision on our behalf. And you're right. Go back a few years, only a few had that. And most had to send the deal to us to review. Now that's almost flipped over. Most have a delegated underwriting authority. And those that don't, we're working digital capability. So we've created an auto decisioning capability, which actually can provide an answer in under a minute. When you fire that off, and we're working with other lenders on how we can actually help them shorten that time to yes, which is everyone's trying to do is how do you take the person out of the market really quickly.
Love it. And one of the other issues that come up from very few from time to time is when a client has, say, gone to a branch and then a loan application's gone up to, say, a mortgage insurer, got declined for whatever reason, and then they've gone maybe to a broker inadvertently, and the broker's gone back to another lender, but that other lender uses, say, Helia, they've declined the loan, and it's like, well, hang on, mortgage insurance has said no, irrespective of which bank you go to. Yes.
Look, generally that will come down to issues that come back to the borrower.
It's at a borrower level.
So it comes and it might be that, and we've seen a default that the lender hasn't seen, right? Because not all lenders have access to comprehensive credit reporting. We do. Most lenders have it now, but at times they don't. So we get to see things that they may not have, which may knock that loan out. Look, generally what we say is, not now, but talk to your customer, understand why it's declined, and then let's work out how we can actually resolve that.
Yeah.
It might mean that you don't buy now or don't get the loan now, but it might be available for you in 3, 4, 5, 6 months' time. All right, but it's having that conversation with the borrower, saying, all right, let's work through what's happened.
Yeah, fair enough. I appreciate that as well. Thanks so much. And then I guess from your view of the world is that you're very pro mortgage insurance. So for someone that's maybe sitting on the fence, what's your barbecue advice? Where you go, hey, look, maybe you can see the world through a different set of eyes as well.
Yeah, of course, we'd love people to use LMI. That's our business.
Yeah.
But look, the approach we take, I come back to we look at what are the pathways available for you to get into the property market, right? And what we encourage is for people to be informed, right? So, talk to your broker or talk to your lender and ask them, here's my situation today. And this is the deposit I've got. This is how much rent I'm paying. Have I got some funds I can get from my parents? Yes or no? Do I qualify for a government scheme? How does that change things? And then what can LMI do for me? And is it the right thing for me?
Yeah, okay. Are there any innovations in mortgage insurance? I don't know, because one lender we've seen does annually, mortgage insurance annually. Are there innovations that you think are in the pipeline around LMI?
So we've got a monthly product out. It's only with a few lenders at the moment, smaller lenders. The bigger lenders would like it. It is a complex thing from a systems point of view to put in. So monthly is out there. We have another thing called family assistance, and that is actually if a family or parents would like to help their child, right? If they pay the LMI premium up front, they're entitled to a 15% discount straight away.
Okay.
Right? And that can help if you've got multiple kids, rather than having to try and fund one with 20% deposit. Yeah. Right? You might be able to pay the LMI for them, and that's a lot cheaper. Yeah. And you're getting a discount there. The other things we're looking at is we've purchased a stake in a group called Osco.
Okay.
And they are a deposit gap funder. And we're just about to pilot that product in the market to see what that's like. And that again is a mechanism where either family can contribute to the deposit, but do it in a structured means, and the family get benefit in terms of interest, but also help their child go through. So that's in the pipe as well.
So that'd almost be like a direct competition to, say, a family guarantee.
Absolutely.
For example, so rather than having to put property up, for example, you can maybe put, is it in this sense cash?
Yeah, correct.
And then it's without having to lock up a property. You go, well, we've got
That's right.
cash. And rather than gifting the kids cash, which has its own knock-on implications, I'm sure when you sign a stat deck that this is a non-refundable cash gift, when actually it's not. That's good. This is actually almost a very fair and equitable and legal way to go about it rather than doing that.
Yeah, and they come with their own complexities. Look, family guarantee is a viable product. Okay?
Absolutely.
But it comes with its own issues. Okay. And again, we want the conversation with borrowers to be put everything on the table for them. Right, and then you can what's best for you, right? If the family can step up, fantastic, right? But if they can't, what else can we do? Or if it's going to create emotional or complex issues with the family, there are other options. So we want you to consider those options.
Yeah, I appreciate it. You start to see that this the LMI conversation isn't just like binary. It has so many grey areas. For example, it's understanding which banks, the LVR, the percentages, for example, how long you want to be in the property, what's your future game plan around to draw up against it at some point in the future as well. So, Sean, I want to say thank you very much. I know it's
great.
I've tried to get this locked in. I think diaries, and I think it's the right time at the right place to have this chat as well. So I'm really, really appreciative for you jumping on. And it's one of these topics where I feel like we're going to get a lot of questions from potential clients as well going, what about this? So if you do have any questions, please feel free to reach out, drop us a line, and we'll be happy to help as well. I'm sure we'll share the tools that you've just mentioned
are available. Yep. If you want to jump on helia.com.au, there's a whole section for borrowers. There's videos. There's the tool that I mentioned, the deposit comparison estimator, available for brokers and borrowers.
Wonderful. Thank you very much. If you found this helpful, please feel free to leave us a review, or even better, like I said, drop us a few comments or questions, and we'd love to help you out as well. That's a wrap for another episode of the Australian Property Investment Podcast. Until next time, take care.